Welcome learners to our third lecture based on importance and techniques of managerial economics. So, in this session today, we will explore why this field is considered the bridge between economic theory and business practices. Now, here we will examine how managers use a specific economic tool to solve real world problems and the sophisticated techniques they employ to ensure long term organizational success. Before dive into the core context, let us establish our roadmap for today, our primary objective. So, the first primary objective is to identify and explain the multifaceted importance of managerial economics in contemporary business. The second one is to master the five fundamental economic tools or principles that guide managerial logic. And the third one, to analyze major techniques for demand, pricing, and production decisions. The next one is to understand how quantitative methods like game theory and linear programming are applied to resolve complex business constraints. Now, let's talk about the importance of managerial economics. So, it applies economic theory and analytical tool to business decision making. Here, it helps manager make logical, data driven, and profit oriented decisions. And its important can be understood through the following key points. There are the number of following key points that you have been seeing this flow chart, where the first key point is decision support. In decision support, its framework for decision making regarding pricing, production, investment, and resource allocation. So, the next key point is optimization of resources. In optimization resources, manager analysis to allocate scarce resources efficiently and maximizing output while minimizing cost. The next is profit maximization. Here, profit maximization determine optimal pricing and production strategies to achieve maximum profit and long-term sustainability. The next one is risk management. Here, it evaluating uncertainties and make decision under risk through economic tools and forecasting techniques, where in policy formulation it supports development of effective pricing, investment, and expansion policy. When we talk about the understanding external environment, it enables adaptation to change in inflation, interest rate, government policies, and global economic trend. As you know very well, that in managerial economics we can study micro and macro in both the levels. When we talk about the strategic planning, the planning is in long term by analyzing economic condition, market competition, and technological change. Next, when we talk about the efficiency improvement identifies inefficiency and improve product and cost effectiveness. When we talk about the market analysis and forecasting, here we have seen the particular market, we have analyzed the actually market trends and consumer behavior and consumer demand to forecast and to stay in the market for competition. Here you have seen the importance of managerial economics. There are the key points we already have to see shown you in the particular flow chart. You have seen that managerial economics helps manager to make rational decision under scarcity. It may not be the guesswork. Optimization use resources allocation, because resources have to be used in an optimal way so that the profit can be maximized and minimize the cost. Apply cost benefit and marginal analysis. The next one is reduce uncertainty in business planning. It means managers have to take rational decision in the business. In the next point, we have already talked about the profit maximization and market analysis in the flow chart, whereas in profit maximization, the manager particular helps determine optimal pricing and production strategies to achieve maximum profit and ensure long-term objective, where manager sees core objective for most private firm and achieved through proper pricing and control policies, whereas in market analysis and forecasting, here the manager analyzes market trend, where which market rules like a monopoly market or monopolistic market. Here particular managers also have to see in the consumer behavior, demand forecasting for future planning, and it helps align production with expected market demand. Moving from the next slide about the risk management and policy formulation, we have already studied that risk management analyzes uncertainty in market condition, uses economic reasoning to minimize the loss. Where we have already talked about this, that manager assists in evaluating uncertainties and make decision under risk through economic tools and forecasting techniques. And when we talk about the policy formulation, we already talk about the it support development of effective pricing, investment and expansion policies, where expansion policies into new market. Here we have seen that economic insight ensure policies are protective and strategic. Again, we are talking about the efficiency and strategic planning. When we talk about the efficiency, we can directly talk about the reduce waste, improve productivity, and optimize internal operations, where manager identify inefficiency and improves productivity and cost effectiveness. Where when we talk about the strategic planning considers helps in long-term planning by analyzing economic condition, competition, and technological change, where it considers inflation, interest rate, and exchange rate also, and adjustment long-term plan based on macroeconomic trend. Here, managerial economics support sustainable growth. Now, let's recall what we studied in earlier slides. Managerial economics importance because it supports rational decision making. Again, next is optimize limited resources. It is important because it drives profit maximization and minimize the cost. Next one is help in forecasting and planning for consumer demand and for new product launch. The next one is guide firms through economic fluctuations like macroeconomic trends related to inflation, pricing, government policies, and so on. Now, let's see the tools used in managerial economics. In here, you have seen the flow chart of tools, where there are five types of tools that have been used in managerial economics. That is the opportunity cost principle, the incremental principle, the equimarginal principle, the discounting principle, and the last one is principles of time perspective. In the next slide, we will discuss tool one by one. Now, let's talk about the opportunity cost principle. What is opportunity cost principle? So you have know that opportunity cost is nothing but a next best alternative used. It means you have to sacrifice once. For example, every choice has a cost. So the next best alternative we give up. So here manager compares option and choose the one with the best benefit. For example, here you have seen that investing in factory waste, investing in financial market. Here manager compare alternatives to choose the most valuable option. Now, the next one is incremental principles. What is incremental principle? So here, incremental principle focus on extra cost and extra revenue. Why? Because, for example, a firm should continue expanding production until where marginal cost equal to marginal revenue to maximize profit. So here expanding activity as long as additional revenue. So here additional revenue is greater than additional cost. Particular in this incremental principle, it is used in products expansion, product line extension, and operating hour decision. The next principle is time perspective principle and discounting principle. The time perspective principle where decision should be considered long term and short term effect where to take long term and short term effects it avoid decisions that harm long term sustainability, so it ensure sound sound capital decision, whereas in discounting principle decision should be considered this should be considered in future income and cost that must be converted into today value, and it helps in pricing and investment decision in long term. The next principle is equimarginal principle where resources should be allocated in a way that gives equal benefit from each use. So here this ensures maximum overall satisfaction or profit. So here business decision about pricing, production and profit. We have seen that allocate resources where marginal return are equal and shift fund to areas generating higher return. For example, balancing budget between marketing, R&D and production prevent underutilization of resources. Okay, let's recall all these tools of managerial economic, the five principles that we have studied in the earlier slide, that is the opportunity cost, incremental principle, time perspective, discounting principle, and last one is incremental. These form the logical base of managerial decision making. Moving from the next, let's talk about the techniques of managerial economics. We have seen that this flow chart where we have number of techniques that has been used in managerial economics. We will talk about the demand analysis and forecasting, cost and production analysis, pricing strategies, profit analysis, capital budgeting, game theory, and the last one is quantitative analysis. Let's talk about the techniques of managerial economics. The first technique is demand analysis and forecasting. Here, it predicts future sales by studying customer demand and price sensitivity. Here, demand analysis forecast future sales, study elasticity of demand, that is the consumer demand for future good, and the last is use statistical tools like regression. And when we talk about the production analysis, it examines production level and cost to improve efficiency and reduce waste. So here production analysis, production function, the production function define the functional relationship between the input and output, analyze fixed cost and variable cost, whereas in fixed cost the cost does not change with change in output, and a variable cost is a change when the level of output may be changed. Here, production analysis determine the optimum output level. Let's talk about the pricing and profit analysis. You have seen that pricing strategies helps to set right price based on market competition and condition where the pricing strategies include cost plus pricing. What is cost plus pricing? Cost plus pricing is adding a profit margin to the cost. Then the second is skimming strategy, is- or it may be called as skimming pricing. It set a high initial price for premium product. The next one is penetrating prices pricing, penetrating pricing, setting a low price to quickly gain market share. Now, but setting the price is not enough. So here manager must ensure the business actually makes profit. Whereas when we talk about the profit planning is uses break even and marginal analysis to maximize the profits. Here break even point is where total cost it's equal to total revenue, and their main target is profit calculation. Here it ensure revenue exceeds total cost sustainability. The next technique is capital budgeting and quantitative technique. Capital budgeting evaluates long-term investment using tools like payback period and NPV, that is the net present value, where managers must decide where to invest a money. It is called a capital budgeting and investment analysis. They use tool like net present value, that is NPV, to check whether a big project is worth the investment and risk. If the return are higher the cost, the project is accepted. But in business this is not done alone, it is a competition. There is where game theory helps. So it allow manager to predict how competitor may react if they reduce prices or launch a new advertisement. So here manager also use quantitative technique like linear programming when resources are limited. These methods help choose the best possible option using data. So in simple words we can say that these tools remove guesswork and helps manager make smart logical decisions for the long term success. Here these techniques reduce guesswork in complex situations. Now, let's recall to the final summary of managerial economics. As we conclude, let us quickly revise what we learned in managerial economics. It's all about the structure and data-driven decisions making. So it gives manager practical tools like demand forecasting, marginal analysis, and even game theory to make better business decision. So these tools are mainly used in three important areas. The first one is resource allocation, where using limited resources in a best possible way, risk and uncertainty analysis, handling market changes and reducing risk. And the third one is capital management, making smart investment and financial decision. So here, when a manager uses this technique, they stop being guess and become strategic decision maker. They can understand the market condition and respond to competition and keep the firm profitable and strong. So, how does a manager make an informed decision? So, by applying these economic tools and techniques in a logical and systematic way as you move forward to your MBA journey, remember these three key terms, that is optimization, increment analysis, forecasting, and strategic planning. This will inform the foundation of your future managerial career. Thank you very much.